Hey guys, welcome back to another video. My name is Josh and today we'll be taking a look at Z. So Z is our favorite petrol company, and this week was a bad week for Z. They announced a big downgrade to earnings and their share price collapsed. As you can see here, Z's share price has really tanked. It started at $5.24 a month ago and it's down about 19.27%. And why I focus so much on Z is because we do have Z in the public portfolio. Our current position is down by 27.79%. In terms of the overall portfolio though, we are over $2,000 now, and the returns are still positive. So that shows you the impact of diversification. But let's talk about Z today, not so much the portfolio. Before we begin, I just want to make clear that I do own stock of Z in my private portfolio. It currently makes up about 2%, as well as you've seen before, stock on the public portfolio on the Sharesies account. What I say in this video is not financial advice. I'm not an authorized financial advisor, so always do your own research before investing, and if you need help with financial matters, do seek help from a authorized financial advisor. And there's really two things that I want to talk about with Z. So the first one being the market study from the Commerce Commission. Z did have a conference call on that, so I'll be talking about that. And the second factor is obviously yesterday's earnings downgrade announced on Friday, and we'll talk about that. We'll see whether Z, is it cheap to buy at current prices or not? Should you be selling? Should you be buying? I won't say, but I'll just present the what I gathered from the conference call yesterday and what I can read between the lines. Okay. So if you enjoy content like this, be sure to like and subscribe. If you want to use Sharesies, be sure to use my referral link. You get $10 when you sign up, and you help the channel because I'll get $5 as well. So that's pocket money that will go into the portfolio. So if you're interested to hear on the conference call, you can go into the Z website and listen to a conference call. But essentially, there are a few things that I wanted to talk about in terms of what I gathered from the market study. The first one was that management believes that the impact on the industry as a whole is neutral. And it's too early at this stage, really, I feel like, to determine whether Z will be ahead of the competition or left disadvantaged, right? So there's a few good things out of the call. The first one was that management believes now that political risk is greatly diminished. What they mean by that is that they know what the Commerce Commission has recommended, and the government has said, we'll promptly, will swiftly implement these recommendations, and that's it, right? There won't be any unseen new regulation that the Commerce Commission hasn't recommended that the government will implement. So in that sense, politically speaking, the risk there is known, and they can sort of work towards that. Some of the recommendations include having a terminal gate pricing, include having a industry code of conduct, and as well as that, having premium petrol prices on the board. And I think that's one really good one. I don't see why it shouldn't be on there. And having prices out there in public just improves competition. And if you're in New Zealand and there's an app called Gaspy, or some people say Gaspy, I don't know why, but this app essentially does that for you. You can search up prices of 91, 95 diesel on the app. So if you haven't already, get on Gaspy. I'm not sponsored, I just use it to stalk prices. So that's quite a good app, and that basically is the Commerce Commission's recommendations. But yeah, it greatly improves competition. Management has alluded to having the capex for including 95 that will cost about $2 million, but other than that, they haven't really sort of gave any guidance on what they think the cost of the other implementations would be. And overall, they see this sort of whole thing as fully disclosed, and now they know what's happening. Risk of further regulation is reduced, basically, and that's good. So that gives us closure to that whole ordeal. So a lot of noise, and the market panicked a bit, on the day of the announcement when, the Commerce Commission is looking at launching a petrol fuel study. But now that that's all sorted, we can put that behind us. And what I wanted to talk about more was the earnings downgrade, because, that was really a driving force in terms of driving, Z's share price down. So this was yesterday, one day ago, Z earnings update. So basically what they say is Z is forecasting a reduction in operational performance for December and the final quarter of FY20 due to the negative impact of low refining margins and continued price discounting in the retail fuel market. So there's really two aspects here. One, lower refining margins, and two, continued price discounting in the retail fuel market, or they otherwise call that as retail margin. Okay, and Z has revised its EBITDA earnings guidance for FY20 to be between 350 and 385 from the previous range of 390 and 430 million. So that is actually quite a big drop, right? So on the bottom end of the range, that's a 40 million, and on the top end of the range, that's a 45 million drop. And as well as that, what we don't really want to hear, but it's the truth, is that dividends can't continue on as it was with earnings dropping. So our dividend guidance for FY20 of 40 cents per share compared to previous guidance of 48 to 50 cents per share. So if we take a midpoint of 49 cents in the previous guidance, that's a 9-cent drop in dividends. Okay, so if you haven't noticed already, the EBITDA drop was actually less than the earnings, than the dividend guidance. So dividends drop more as a percentage compared to EBITDA. The reason for why dividends dropped more than the earnings guidance is because Z was previously able to maintain the bottom of its original dividend guidance by increasing the payout ratio to the top of the range by making minor adjustments to capital strategy. The additional reduction in earnings is now at a level where Z believes that it should let the reduced earnings capacity flow to the dividend rather than compromise its payout ratio or debt reduction program. They don't want to pay dividends out just because, it'll please shareholders, but they're also taking into account their debt reduction program, reducing debt over time, as well as not breaching that payout ratio of 70 to 85% of free cash flows. So that's why dividend had to drop, and you'll come across situations like this where companies reduce earnings and likewise they have to reduce dividends. If they reduce earnings but don't reduce dividends, then you have to ask whether, how are they funding this dividends? Are they funding it through borrowing more or, raising capital sort of thing? So always be on the lookout when that happens. That's not a good sign. From the first guidance that they issued, there was a reduction of 120 million from the midpoint. That is a big drop. 120 million, not very good. So management is very bad at forecasting. That's what we can see from here. Okay. And so there's really two factors here. And I listened on the conference call and it's provided a lot of perspective, right? So the first one is refining margins. So refining margins are currently at a unprecedented level where there's really no historical evidence to show that it can continue on. That's what management said on the conference call. What they're trying to say is, we're at a level that is unsustainable and it'll probably have to improve over time. But they did say that the forecast for the next quarter is, at current levels. So that is levels that they've never seen historical evidence of. So they're kind of going into uncharted territory. So refining margins have taken a large hit. So the 120 million, 20 million is due to refining margins and 90 million from lost retail margins. So retail margins include selling petrol to customers, how much profit you make. So previously management strategy was being a price leader in the market, having a higher price, offering more services and getting a higher fuel margin, even though they might not sell as much volume. And if you remember, you might have heard on the news on the day of the tanker explosions, all the petrol prices went up, and Z was the first one to increase their prices. And what they found was that no one else really followed. No one else really followed their price leadership, and then later on they had to decrease their price. So that just shows you how sensitive to prices customers are, right? They're not really concerned about branding or loyalty schemes. They're more concerned about prices. And so management has caught on to that. They've noticed that the volume to margin ratio payoff is more weighted towards volume. So in terms of making more money, where that's coming from is from selling more rather than selling for a higher price. In a nutshell, basically, management has said, we were faced with a unique set of circumstances where we have retail margins that are at low ends and forecasted not to have any improvements, as well as super high competition. Retail margins are at all-time low as well. So that's a double whammy, and that's why the profit downgrade was so big. If you're worried about Z going out of business, don't worry too much yet. Management has said that they're very far from breaching debt covenants. Remotely going out of business, they're quite a long way from that. They're still generating a lot of cash flow. That's what they're trying to say. So at the midpoint of their earnings guidance, and as well as a dividend payout ratio of 70 to 85% of free cash flow, the current dividend is at the low end of that range. Okay, so dividend is quite secured, but I don't want to say that as well. I take that with extreme skepticism because management has not proven that they're very good at forecasting. At current prices, we have a dividend forecast of 40 cents per share. And if we add back imputation credits, we get 55.5 cents divided by current share price of $4.23. We get a dividend yield of a gross dividend yield of 13.1%. So is it a good buy at the moment? So personal opinion now, not financial advice as well, this whole video. So in terms of buying more, I'm a bit careful as well, but we'll see how things play out. And I'll watch from a standby point. In terms of the Sharesies portfolio, I do believe in dollar cost averaging in. It can continue to drop, it can go back up, no one knows. But what I can say is if you're currently buying at current prices, management is guiding for a 13% dividend gross yield. So take of that what you want, and do take that with a grain of salt as well. As I've mentioned, management is not very good at forecasting. So yeah, that's all for today's video. And I hope you enjoyed this update on Z. If you enjoy content like this, be sure to like and subscribe. Until then, take care.